Hello, everyone, and welcome back to our live session as part of the FLC Tech to Market Virtual Forum. My name is Tom Stackhouse. I am the Associate Director for the Technology Transfer Center at the National Cancer Institute, part of NIH, and I am also the Vice Chair of the Education and Training Committee for the Federal Laboratory Consortium. I welcome back those who had joined us earlier this morning for the talk given by Paul Zielinski on Lab to Market. And now we're moving into our next session, and I'm very excited to introduce you to Ms. Rosemary Truman, and I'll do that introduction in just a minute, but I do want to remind you that if you have questions during the session, please enter them into the chat box that's on your screen, and they will be answered. We will answer the ones that we can during the session, and at the end there will be some time left for questions and answers as well. So, moving forward. Again, it's my pleasure to introduce to you Ms. Rosemary Truman. She is founder and CEO of the Center for Advancing Innovation, which is a global public-private partnership whose mission is to accelerate and increase the volume of technology transfer, translational research, and commercialization. Rosemary has more than 20 years of experience driving growth for clients, having created over 20 for clients that launched over 50 new products and services and solutions. Her experience spans strategy consulting, investment banking, and entrepreneurship. And prior to launching her own firm, Rosemary served as the global leader of IBM and PRTM's innovation and R&D strategy practice, the vice president and head of global research at Marsh & McMillan, and the leader of Oracle's Advanced Technology Group, as well as the leader of the e-business strategy while she was at Ernst & Young and Booz Allen and Hamilton. I want to point out that I have had an amazing opportunity to work with Rosemary over the past 2 years, where together with the Avon Foundation for Women, we launched the Breast Cancer Startup Challenge, which is in its final stages and launched now 11 new startups from 10 different inventions, 9 from the Federal Laboratory. More recently, Rosemary and the NIH partnered with the Heritage Provider Network to launch the similar challenge that's focused on technologies that will benefit diagnosing and treating various neurological complications, and we call this one the Neuro Startup Challenge. Today, I believe we will hear a little bit about these challenges as Rosemary covers this tough topic of technology valuation. And with that, I will turn it over to Rosemary. Rosemary?
Thank you very much, Tom, for the kind introduction, and I just want to, again, thank everyone for coming today. I'm thrilled to have an opportunity to present to you. This is one of my absolutely favorite topics, valuation. Valuation is a very complex topic. It is littered with acronyms. So I'm going to start by telling you that as a basis for really understanding valuation, it's very important to understand profit and loss statements, or what we call P&L statements that the companies create. So I'm going to start going through the presentation now. So what I'd like to do is walk through, what is valuation, why is it important, go through some terms and definitions, and I'll be going through a deeper dive of the terms and definitions a little bit later in the deck. We'll walk through some guiding principles for practicing valuation. We'll have an overview of a simplified valuation model, and by that time, you'll be happy that I'll be presenting that because it is a complex topic, and actually I'll walk through a case study as well. So what is valuation? So for everyone in technology transfer, it's a very important topic because what you're doing probably every day is figuring out what your inventions are worth. So valuation is what a company's worth is, an invention's worth is, and it can also be what the fair market value of the owner's interest in a company is or an invention is. So if you have 3 PIs working on an invention, what are their respective, what kind of worth do they have as part of that invention? The reason it's important to the world because investors will make a decision about how much they're going to invest and what they're going to ask for that investment in terms of a part of the company. So when a venture capitalist or a large pharma or an angel investor decides they're going to invest in a startup, for example, they will create their own valuation model to determine what the startup is worth or the asset is worth. And then they will ask for a certain percentage of equity or a piece of the company in return for that money. And all the negotiations for large pharma or large pharma venture or venture capitalists or angel funders are based on this valuation. So from an internal standpoint for technology transfer professionals, it's very important for licensing negotiations, because if you if the entire asset is valued at $1.3 million, which we'll see in the example I have today, this is actually it's a therapeutic valuation model. And typically they're, when they're in the preclinical phase, they're about 1 to 2 million. And then the valuations change as you go along, but they're very important for licensing negotiations, so you can actually determine how to make sure you have a fair upfront payment and milestone payments. They're important for M&A, and they're important for any investment decisions, and also capital allocation. So the biggest issue you run into with valuations is sometimes there's a disconnect between the value of the organization and the amount of investment required. So it's important to make sure you can get to a very strong valuation based on quantitative data. So I'm going to actually walk through some additional definitions based on some of the points I raised on the last page. There's actually two kinds of funding. There's dilutive funding and there's non-dilutive funding. So non-dilutive funding is when a startup or an organization receives money to do a particular project, and essentially what they're going they're going to create as a result of that are progress reports or a paper. And the sources of non-dilutive funding are government organizations like SBIR grants, foundation grants, economic development organizations sometimes give out non-dilutive funding, state organizations give out non-dilutive funding, and then there's some other non-traditional sources of non-dilutive funding, which are business plan competitions, for example. So the reason it's called non-dilutive funding is because you don't have to give away part of your company or part of your asset in order to get the funding. Typically, there is a stipulation, as in you have to create a paper or you have to create a progress report to show that you've progressed your invention in a particular direction, but they're not asking for a part of your company. The money is typically given for a particular period of time. It could actually be recurring, and there's no need to return the funding. I think that's a key point. For dilutive funding, this is when you have to actually give away part of your company in exchange for the funding. So the big difference is you also have to give the money back, and you don't have to give just back the money. You have to give like 10 times the money back. So when an investor invests in a company or an asset, and they get part of that, they get equity, they want to have their money back in 2 to 10-fold. The sources of dilutive funding are private equity, venture capitalists, large pharma corporations. Usually they actually have that's not their licensing group, but it would be their head of business development, like their business development groups. Large pharma venture are good sources of funding. Family and friends are good sources of funding as well. But again, they're going to want part of their part of the company in exchange for the money. So the main thing is, if you have $1, where do you put it? There's a large number of companies and a large number of assets competing for valuable capital. So what VCs want to do, venture capitalists want to do, is they want to get the most back out of their money. So on the left-hand side, you see an example in year 1. The worth of the investment that they make is $50 million, and then by year 5, that investment has turned into $100 million. The flip side of that is in year 1 they put in $5 million, and in year 5 they get out $100 million. So clearly, if the equity structure of the company or the asset has not changed, the 20-fold return is much, on the right-hand side, is much more interesting than the 2x return on the left-hand side. So, question comes up, when should you do your valuation? And that's a very easy question to answer. Anytime you want to know what the worth of your IP is, you should do a valuation. So that means that if you want an asset, if you're on the company side of things, if you want an asset that you're eventually planning on commercializing, so you're going to license an asset, an invention, you're going to do a valuation. So anytime an organization like a large pharma comes to a National Institutes of Health and says, I'd like to license this invention, typically they will have already performed a valuation and they know what they're willing to pay, and they know how the valuation will change over time. So essentially, any time you're trying to negotiate dollars for an asset. Also, another time you should do a valuation, as Tom mentioned, we launched the Breast Cancer Startup Challenge, and out of that challenge, we have 11 new startups. So every single startup out of that competition has performed a valuation because they're going around and they're pitching for dilutive capital. So they're pitching to venture capitalists and private equity firms, large pharma, et cetera, and again, in exchange for funding, they're going to have to give away part of their company. And they don't want to dilute themselves out.
You said put them in the cabinet.
I said don't put them in the cabinet.
If only I could record
so the point that I made earlier was that the valuations change over time. So typically in the pre-IND phase for therapeutic, you're looking at about a $1 to $2 million valuation. And that's for an asset that could be a $3 billion invention once it hits the market at its peak, not in perpetuity. So the valuations change as they go along. There's a concept called pre-money valuation. Pre-money valuation is the valuation of an asset or a company before it is able to obtain any dilutive funding. So that means it could have had lots of government funding, it could have had lots of foundation funding, it could have had, you could have written a business plan and entered that business plan to business plan competitions and received non-dilutive funding. But so pre-money valuation is before the first dollar comes in, of dilutive funding. Then after that, it all depends on the negotiations as they go forward. And that's why performing a valuation with as much quantitative facts as possible that rely on assumptions that can be backed up are critically important. But you see these red arrows here are really when the valuation changes, and they're called value inflection points.
99% of relationship problems happen.
I'm going to put forth a disclaimer, though. There are a lot of opinions about valuation modeling. It's almost like a religion. People adopt what they believe in, what they have experience with. There's not a gold standard. It will remain probably subjective until the rest of my life. I've had lots of conversations about it, but at least what we can discuss today are some of the pros and cons of different models, and I'm going to walk you through one model, two models actually, of performing valuation. So the typical valuation models that are used in this industry are NPV, which is net present value, and you can see on the left-hand side, the first table up there, at what points in time net present value is used when they're generating ideas, preclinical, phase 1, phase 2, phase 3, market approval. And so this is for the, and then you can see across the top here, there's several different kinds of valuation models. So as I mentioned, NPV stands for net present value. Our NPV stands for risk-adjusted net present value. BS stands for Black-Scholes model. So Black-Scholes model is not very appropriate for the life sciences industry. It's mostly used when you're trying to predict price distribution. Black-Scholes is also typically used when the risks are very well known, and in fact almost risk-free. And also the volatility of the asset, or how the company will progress, is known, or it's constant. So it's, like I said, it's not very appropriate, but it is used on occasion in the life sciences industry. BIN is a binomial tree model valuation. It has a bunch of weaknesses. It's based on, has a bunch of weaknesses, but strengths as well. It's based on real options theory. So the whole concept around the BIN binomial tree model is to actually create a full range of possibilities for the asset or the company, and then model all the uncertainties around those potential scenarios. So it is used in oil and gas, and another kind of evaluation that's like it is called DSP. So there actually, by the way, there's a lot of valuation models that are not on this chart that you might have heard of in the past. Comp is comparables, and then, as I mentioned, there's some others. You can see that from this chart, risk-adjusted NPV is the one that's used the most often, and it's actually the one that I use personally the most often. It's complicated. It requires a lot more analysis than some of the other models. In order to build a risk-adjusted NPV, you actually have to create an NPV first. So it's like you still have to create the net present value model. I always, when we do valuations, we do it two ways. That way we can kind of triangulate. We do a risk-adjusted NPV and also a comparable. And you can see at the bottom, these are with companies. So the top is like, an asset in different phases, but the same is true with companies. So for, again, what you're seeing here are the advantages of the different valuation models: NPV, risk-adjusted NPV, Black-Scholes, binomial tree method. So you can see that the biggest weakness, if you will, of the risk-adjusted NPV is that it requires a lot of input. So in order to construct a risk-adjusted NPV, that's why I said a P&L model, a profit and loss model, is really important to understand. It requires a comprehensive P&L model until the until the patent is done with its life. So it's usually about a 20-year model. We usually go out at least 20 years. Usually, I shouldn't say at least, 14 to 20 years, depending upon the age of the asset. It does, it's suitable for multi-phase investments. It's one of the key elements about why it's strong. It does rely on success rates at each stage. That's why we have to risk adjust it. So I'll actually explain what success rates are. So you're going to be looking at success rates per phase of the clinical trials, or if it's a device, per phase of either the trials or the other stages of devices and diagnostics. So now we're going to be getting into some more definitions. So NPV is the net present value of earnings. So earnings is profit minus cost, like COGS and SG&A. So COGS is cost of goods sold. SG&A is your administration overhead costs, if you will, for a company. So the way you measure earnings, there's a few different ways, but it's called usually EBIT, earnings before income and tax. So it's essentially profit. So what you're looking for is the net present value of profit over time, and based on the investments as well. The risk adjusted is all you're doing is applying risk to that model. You apply different amounts of risk depending upon the stage that you're in, because there's different levels of uncertainty and decision options. For both the NPV and the risk adjusted NPV, they have a component called an IRR, which is an internal rate of return, which essentially compares the profitability of two different investments. Essentially, what you're doing with an internal rate of return is you're saying, if I had option A or if I had option B, it will allow you to compare those two options over time in order to see what return rate you need to achieve to make both options equal. So let's you decide between which option is going to have the highest return for you. It's also known as the hurdle rate. Industry typically uses the term hurdle rate, but in financial terms it's IRR. It is in the life sciences industry. It's typically 43 to 50%, which is a very high IRR. That's why there's such a multiple required when they want their money out. So comparable is actually somewhat is a bit easier to use. It compares the value of an asset to a similar asset. So, for example, if you have an invention that is in the nascent stage, like a preclinical, with statistically significant data, and there's another invention that is in, let's say, has been funded 3 times, so round A, round B, round C of funding, you can usually compare, the funding typically reflects the valuation that an investor has kind of graded the asset at, so you can reverse engineer what your asset might be worth. So it's you can also, by the way, do this, of course, with inventions that are on the market. So comparables are much easier. You just lay down the characteristics of your invention, find similar ones that are either raising funding or have started as a company and are on the market.
Rosemary?
So,
I have a
yes.
basic kind of question here that I think probably many people might have on their minds. Is a lot of folks who are online or from federal laboratories, and the question is, are these evaluation models valid for determining how to value IP for a license agreement and how much a lab should be asking for in royalties from a license?
Absolutely. Absolutely. Because that your potential quote-unquote client who's going to be trying to do the licensing deal with you will have done their own if they're savvy. So if they've done their own and you've done their own, you can actually have a really strong conversation based on fact. And I think they're extremely valuable for what you determine your upfront payments are, your milestone payments are, what your royalty rate should be, for sure. Good question. So what are the steps? There are basically 3 steps, but there are some sub-steps to these. So the first step is to define your financial needs. Essentially what you're doing when you define your financial needs is you're determining how much money you need every year in order to get your invention from preclinical all the way through to the market and actually kind of manufactured, marketed, etc. The second part, and by the way, the financial needs is constructing that P&L model that I mentioned. The second part is calculating the risk-adjusted NPV. And then the third part is a bit of a deeper dive, which is getting into the specifics around pre-money, post-money valuation when you are talking about pre-revenue startups. Okay, number 1. So to define your financial needs, what you're seeing on this slide is you have to determine kind of what your product revenue is going to be over time. It's going to be 0 at first, if you're in preclinical. These are the phases and years. And by the way, this is continuing. So you can see then the idea is to get this on the market in year 11, so your revenues will start to go up. So the second part of that is determining... Yes.
Just real quick. So that seems like a long time period for some folks who are not in the health arena. So can you speak to maybe how that might operate for other types of technologies that aren't necessarily in the health field, life science field?
Oh, yeah, absolutely. It's a great question. Yes, so for example, evaluation for, the valuations vary across the board. So evaluation, I'm just going to use this as an example, but in the oil and gas field, you're usually looking about 30-year valuations. In the high-tech arena, you're usually looking at 5 to 10-year valuations. Yeah, what essentially you want to do is construct your valuation according to the number of years is going to be patent protected. Hopefully that answers the question.
I think that's a good point.
But the other part of the other part about how long you model it for is how much time is it going to take you to get your investment out of the asset. So if I go back to oil and gas, the reason it's a 30-year model is because that's how long it takes to get your investment out of a $8 billion investment. If you're, because that's how much the investments are in that segment. In the life sciences industry, they could go up to, obviously there's a big debate about how much really you need for life sciences. If you look at this model, it's about $50 million that goes into this particular asset. But and sometimes in oil and gas, if you look at indirect, so sometimes in life sciences, if you look at direct and indirect costs, it could be anywhere from $1 to $3 billion. Indirect costs being the cost of other assets failing. For a startup, you should just really look at how long the asset's going to be around. So, for example, in diagnostics and devices, it's usually a 10-year valuation, not a 20-year valuation. That's a great question. So let me explain some of the things. So normally, if you were looking at a P&L, a profit and loss statement, because that's what you're seeing here on the slide, you're probably going to see like 100 lines. So this product revenue, the buildup for this product revenue is probably 50 lines because there's a lot of assumptions involved. So, if you look at life sciences, you have to look at the number of cases per year, like the incident rate, the prevalence rate. You have to think about the annual population growth. You have to think about peak market penetration, revenue per unit, the market ramp time, how much time is it going to take you to get peak penetration rates, meaning let's say your addressable market size is, 300,000 people, and that's addressable market size. How much time is it going to take you to get full adoption for that 300,000 people? So if you think about the iPad, I think that Apple probably thought that 50% of the iPhone users would probably adopt the iPad, just as an example. And so the question would be, how much time has it taken them? So if you've read if you read the news around the iPad, it took them about 3 or 4 years before they got peak penetration. And obviously innovation changes that because if they come up with something new, something smaller, something different, that'll change. So the first part is building up your P&L. So that's as I mentioned, your revenues, your costs, and then basically what's called your net contribution margin. So that's the subtraction of the revenues minus the costs. The second part of this is figuring out how much you need per phase. So what you're seeing here in Part B is just the sum of what you have for preclinical, phase 1, phase 2, et cetera. It's just a cumulative view. So the second step is to calculate your risk-adjusted NPV. So the parameters here are, you have to think about risk mitigation, the probability of success that you'll have per phase when you're in an early stage or later stage. So if you look at the right-hand side here, if you're talking about a therapeutic, for example, in the preclinical stage, there's about a 10% chance of success for that invention. In phase 1, it's about 20%. Phase 2, it's 30%. Phase 3, it's about 67%. And by the way, this is the general rule of thumb. This changes based on the therapeutic area. So we, for example, change this based on if it's a neurological therapeutic versus an oncology therapeutic. It can also change based on indications within that particular area. But the important thing is to know what the stages are for your invention. So we're working actually with some NASA inventions right now, and their stages are very different, and their probabilities of success are different. So you have to actually think about this for your specific area. So then you have to know what are the investors' internal rate of return. So as I mentioned, for the life sciences industry, investors are usually at the 43 to 50% range, which is a very high hurdle rate. So, if they can they're looking for 50% return. So they're only going to put $1 in someplace for a 50% return. In the high-tech world, it's lower because the risk is lower, the time to market is lower. There's a lot of reasons, but usually in the high-tech space, it's about 20 to 40%. We actually have worked with people in the high-tech space who go as far up as 40%. It's usually 20 to 25%. So you'll just need to know what what the internal rate of return that's required of your potential licensee is. So then what you do is you lay out the risk mitigation against the phases, and that's what you have here. So as I mentioned, these are the general biotech benchmarks for discounted risk and the discounted rate. We actually have these for other industries if there's any interest in reaching out and letting me know if you have. I unfortunately didn't put it in the step, but if you have interest in knowing more about this, I could discuss that offline. So now what you're going to do is calculate your risk-adjusted cost. So all you do there is you take your risk mitigation rates, you lay it across your phases, and as I mentioned before, you have already had to calculate the costs. So these are your R&D costs, and essentially how much seed funding you're going to have to get raised in order to get your product to market. So you're just calculating. You lay the 10% down, 10% times divided by. Divided by. You have to divide the yearly cost. So it's 515 divided by 10%. So the next step is to calculate the present value of revenue and risk added cost. So the present value is the current value of the money or the technology or the investment that has been discounted to reflect its value if it existed today. So it's called the present value of revenue and also the risk-adjusted cost. So if you look at the diagram below, what you see here is that you create you apply a formula. It's a cumulative formula. You use the internal rate of return as part of that formula, which is this 43%, and you create the present value of revenue, which is $101 million, or $102 million to round up, and the present value of risk-adjusted total costs. So if you open up Excel, it's a very long formula which basically takes into account your product revenue and your risk-adjusted total costs. So in the last slide, we actually went through how to calculate the risk-adjusted total costs. And that gives you then the present value at year one. So here we have it. It's kind of summing out all this up. What is your risk-adjusted present values? And this is what's going to get you your pre-money valuation. So as I mentioned before, you adjust your present values by the risk probability of the current year in development phases. So we're using 10% in the preclinical stage, year one. So this is the present value of revenue and the present value of total adjusted costs, which we had on the prior two slides. You now risk adjust them, and that'll give you $10 million approximately and about $9 million in risk-adjusted cost. You subtract the two, that gives your risk-adjusted net present value, which is your pre-money valuation. So that was your pre-money valuation. That's not an easy thing to do. So I'm proud of you all. You all stuck with me. So you had to, just to kind of recap, you had to construct your P&L, your profit and loss statement, to the point where you actually have all your value inflection points are complete and the life of the patent is over. So that's why sometimes you see these at 20 years. You then, as just kind of recapping, going back a little bit here, you then, so that's your P&L, you then actually risk adjust, find out your risk adjustment factors. You apply your the risk adjustment to your cost. You then find out the present value of revenue and the present value of risk-adjusted total cost. That gives you your present value. You risk adjust your present value, and that then gives your pre-money valuation. So pre-money valuation, complete. So then what happens is someone will actually invest in you, like an investor that has dilutive funding, so a venture capitalist, a private equity organization, an angel funder, or a collaborator like large pharma. That will then give you your post-money valuation. So this is somewhat of a negotiation, the amount invested and the pre-money valuation. So after the post-money evaluation, that'll be the value of the company after closing their very first round, And every single time you close a round of investment like Series A, Series B, Series C, you will actually have a new valuation. The equity is the total ownership of the company amongst the stakeholders. So usually the equity is there's equity given to the first funder. There's a lot of different deal structures that have been created. So equity could be also provided at different times. If two individuals own 1,000 shares, of 2,000 shares, they have 50% equity. So it's how the company is distributed. The terminal value is the value of the company at exit. So this is when the point in time when the investors can liquidate their assets. And then the return on investment, which we're going to be using in a moment, is return expected on the investment in the company. So as I mentioned before, it's usually 2 to 10x, more like 8 to 10x. So going into a bit of a deeper dive here, as I mentioned before, one of the first steps you're going to take is determine the total investment amount needed. So this is just a bit of recapping. So the reason you're going to do this is because it's going to help you create your pre-money valuation and your post-money evaluation. The guiding principles around determining this are, first of all, to be realistic. If you need $38 million in total to reach the market, then there's no other funder that will ever come in, but that's not realistic. So you usually want to calculate the amount of money you need to get to the next value inflection point. It's supposed to cover a phase, so like at preclinical or phase 1. So each time you get through a phase, that's a value inflection point. There are some investors that have different investment philosophies. They do not want to have the startup continuing to churn and raise money. So I know only one investor like that where they actually would provide enough money to get through phase 2. The other key point here in terms of guiding principles is use other non-dilutive sources to fund gaps in funding. So when you're calculating the post-money valuation, it's very simple. The post-money valuation is the sum of the pre-money valuation and the investment amount. So if an investor comes in, we said that our valuation was $1.3 million. If you have an investor come in at $515,000, the post-money valuation is $1.885,000. Then all you have to do to figure out how much equity should be exchanged for that is you just take the amount that was invested and divide it by the total valuation. So if you have an asset and you're a licensing specialist, obviously you want to have this valuation number be as high as possible. I have seen several times. It's very, very important to be cautious with the valuation number because if you're too aggressive and the valuation is higher, it will be very difficult to come to a deal. So, but it's very important for the person who has the asset to be as high as possible. So in any case, this would equate to 27.3% equity that would be requested in exchange for that funding. So then, now what we're looking at is the end-to-end ROI expectations. What does the investor want? The return on investment, and what type of risk are they going to be expect in exchange for that funding? So the ROI, as I mentioned, is the total return that investors will expect to get back out of their investment. So it's the gain from the investment divided by the cost of the investment. So if our investor, which invested $515,000, wanted a 5x ROI, the investor would have to receive $2.5 million. And obviously it would have to be twice as much if they wanted a 10x ROI. So they're usually going after about a 10x ROI because if it's early stage, because the risk is still too high. If it's later stage, they would have to put in more money for a smaller piece of the company. Typically when a company is like the first round of funding, they will receive a 2 to 5x dilution because what happens after each round of funding, and what you do is you create what's called a cap table for this. It's called a capital table. it's a way to model how each round of funding will dilute the value that you have in the company. Because if another funder comes in and puts another $1 million in, you can see what will happen. The valuation then goes to about $3 million, and now your piece of the pie is less than 27%, right? It's about 10%. So each round of funding is going to dilute you further, which means that in the end of the day, the first funder really wants to have anywhere from 30 to 50x to adjust for dilution. And then one thing that is very important is to gut check your forecast. It's to do a sanity check on your forecast, and also test it against your concepts around exiting. So if our investor wanted an investment multiple of 5x, the total exit value has to be proportional to the equity for the investor. So remember, our investor claimed 27.3% in equity. The gain has to be 23.7% of the total exit amount. So this means that the exit value will need to be the total exit value times 27.3%. So we'd have to take 2.5 million and divide it by 27.3%, and that means the exit value has to be at least 9 million. If there's nobody else that had come in to provide funding. So the question is, if you need at the end of the day $35 million more, is it realistic to get the exit that you believe that you're going to need to achieve? So does your financial forecast support your exit amount and the percentage of equity that you're receiving? Because then you'll have to reconsider if it doesn't. Are your expenditures out of whack? Is there any way to reduce them? Are there avenues to ramp up your revenue and your market share better? If your financials don't meet your exit requirements, you just have to go back to the model. And by the way, we do this all the time. We go back to the P&L forecast, and we look at the different assumptions and see if there's anything that we can do to drive value faster. So in this DEX example case, the revenues actually did ramp up to $1 billion by year 12. You probably saw that. So it will be far above the 9 million threshold. So end to end, if your current valuation is $5 million today, post-financing in your high-tech firm, a new investor owns 25% of the company, so it's $1.25 million. What do they want for their financial plan? So they want a stake up to $12.5 million. They want a company valuation up to $50 million, and within 5 years without any dilution to subsequent financing. This would mean that you would have to have your earnings before income and tax up to $5 to $10 million within that period. And actually that's pretty realistic for high tech. But what you'd want to do is make sure you don't approach investors with anything lower than that. So the tips are, just know what your investors are going to want to have, and I think just for the licensing specialists on the phone, professionals on the phone, the key is to understand what the valuation of your asset is before you go into a licensing discussion, so you know it's fair to ask for an upfront payment. It's basically the amount of risk, the amount of money that the organization. You have to think about what their internal rate of return requirement is. So if they put $1 into your asset, are they going to be able to get that out of there? Because they're going to want to, internally they're going to want a rate of return that's high. So one thing we didn't discuss.
Along that line, I think we are having an interesting conundrum here, because I think a lot of us on the line are considering just exactly what you just spoke to, and that is, how do we value the technology? And certainly what I'm hearing from your talk is that in order to truly get at the value of the technology, you have to assume these models and develop this analysis of what's that company that's going to take that technology going to have to go through. Is that correct?
That's exactly.
Okay. So I think that's where there's some confusion potentially with the audience. So they're looking more at how can I just take this technology that I just patented and get some kind of estimate of a value on it. So.
Yeah, so in order to get a really good value, you actually have to go through and model exactly what it's going to take to get this invention on the market. And then, because that's what the company that's coming to you is doing. And then what kind of revenues and profitability am I going to get out of it? That's what the company is going to do. So in order to go into when you go into a licensing discussion, typically the company has already done that analysis, or they wouldn't really probably come to the table, because they need to know enough about the invention so that they could have performed this valuation, because they're taking risk. And for a life sciences company, they have such a high hurdle rate. Their internal rate of return, if they put $1 anywhere, they want 50% out. So they don't do that for every single investment, but for an early stage investment, that's what they are wanting out. The other alternative you can use, which is, I have this on page 24, is a comparable model. It's a bit dangerous unless you really do a complete characteristics analysis of your invention. So what you have to do is say, okay, I have a therapeutic, it has this much data, it has this kind of data, it has this mechanism of action, it has this target. And you have to kind of write down all the characteristics of your invention. And then you need to find other inventions like that to get a peer comparison. And the kind of comparison you want is one that is actually either has raised a couple of rounds of funding, so it shows success, or something that is on the market that's already being sold. But maybe it's slightly different in some way. Your invention's faster, or you take less of it in terms of the standard of care is better, etc. For life sciences. But you do this comparables analysis. You do that same kind of analysis in every industry. You just try to find peers that are either in raising funds or already on the market. But it's critical that they have the same fundamentals. That's why I caution against this model. But my personal feeling is that, and in fact it's the way we've gotten really strong numbers that are defensible, is doing evaluation. So that you wouldn't want to compare. So as an example, if you all know Zacks actually has some fantastic, very minute details on P&L structures for independent inventions, not for entire portfolios. But for sure, what you wouldn't want to do is compare one invention with a company that has a portfolio of inventions and just look at their broad P&L. You would have to break down their P&L to the extent that you're able to isolate one invention. So you don't want to, that's very dangerous, compare one invention to a portfolio. You want to identify comparable companies that have attracted money, or, so for example, seed funding. You would basically deconstruct their pre-money valuation. You just do take what the VCs have invested in, and then you actually reverse engineer it, because you apply the multipliers that I've been talking about all day today. So those multipliers, you can even just use a range, because then you can, at least in your negotiations, you can say, okay, well, the low end is this, the high end is this, and then you'll have some play, if you will, in your negotiations. And then you want to adjust your valuation based on both tangible and intangible factors. Maybe there's a very strong relationship between the inventor that has has created the invention, and some other collaborators in the field that are kind of the key people, the key opinion leaders for that particular area. So it could be a people orientation, or it could be like a somewhat intangible factor, but there could also be some very strong tangible factors about the invention itself that makes it better than the one that where someone else has raised 2 rounds. And there's some very good examples of this in the breast cancer space. Some of the parts, if you are looking like at a family of inventions, you actually like a portfolio of patents, if you will, and you're going to actually try to license the entire bundle. then you use this model called sum of the parts. So you have to actually take each invention and value it separately, and then then you have to sum up each of the pieces. That's really the best way to get a kind of like a family of patents valued. There's a lot of other comparison rates that are really not that useful in life sciences. The best one to use is there's a price to earnings ratio. That's not really very useful. EBITDA is earnings before income and tax. That one sometimes could be useful. But that's looking at profitability. I mean, really the best way to do it is to look at a company that maybe hasn't already gone to market, still raising money, and then try to reverse engineer the venture capital valuation if you're going to do a comparable. I think personally, like I said before, you should really try to do both if you can. And maybe what we could do is actually have a meeting, a webinar like this specifically on how to build up a P&L, a profit and loss structure, because that's kind of the foundation for doing the valuation using a risk-adjusted NPV. So the key points, to hide to some of your these guiding principles for risk-adjusted NPV, you're going to model a complete view of your P&L until you get to revenue, and you need to understand where your peak revenues are going to be. And then when also it could go off patent and what will happen when it goes off patent. So there's some very clever things that can happen. You might have seen Lipitor went off patent, and obviously generics came in. What Lipitor did was they had a very good marketing campaign, and they said, oh, you get Lipitor for half price, but of course generics were a lot cheaper than that. But they still were able to retain at least 30% of the people who are taking Lipitor, because people don't like to switch drugs. So there's ways also to model post-patent revenues and costs, because basically they're just raking in profit on Lipitor. It's to produce it. It's really the R&D cost is the largest cost in most industries. You want to construct your value inflection points and understand at each value inflection point how much your valuation changes, and create scenarios of what an exit would look like. So typically you're going to exit in phase 2 and with startups. It all depends, though, on the dynamics of the particular area that you're in. We saw in the antibiotics area very strong phase 1 exits we've modeled, actually very strong phase 1 exits. That's unusual, but in the multi-spectrum antibiotics, it is gram-positive, gram-negative. You can get really great phase 1 exits, and also if it's an area of military interest. Phase 2 is typical. For the research comparables and benchmarks, look at recent investments and what is the standard, the average investment multiple, and then again, like I said, you can reverse engineer that. And of course, what you want to do is match the forecast with what the inventor's needs are. How much equity will they take? What are they going to expect in terms of the multiple? And what does your financial forecast allow for that return? So you're going to have to go back, sometimes you just go back and tweak it and see what you have to do in order to get to multiples that will be acceptable to investors. And that investor includes your licensee because they're investing in the asset. Okay, so just to review.
This is Tom. I have another question for you.
Okay.
This question is kind of related to the background of the individual who does this type of analysis. And the question is who, and this is asking it from a university perspective, who decides for the valuation of innovation in a university setup? It says since the idea is lab to market commercialization path, what expertise in terms of education or background is needed for this valuation calculation?
That's a great question. It depends. It depends on the valuation model that you're using. But if you want to use this example that we're talking about today, for example, the best place to get this kind of experience is from so analysts in private equity firms are taught this. In strategy consulting, we are taught this from being a baby consultant. It's one of the models they teach strategy consultants. But the problem is without industry expertise, you can't do a good valuation model. So in order to really get a good valuation model, you need two things. You need industry expertise on the dynamics of the industry. For example, attrition rates in clinical trials or death rates in particular kinds of clinical trials. And you have to know how to analyze that, get that data. So you need that kind of, being able to create that kind of assumptions based on real data, but you also have to know how to actually work up a proper valuation. So my opinion is that I don't know from a university standpoint where you would get that internally unless you would actually have a kind of a market attack team that would help you with your commercialization efforts. I couldn't actually tell you if I know of any in particular role. I would suggest that role be added because that could be extremely helpful for very strong negotiations with industry that are based, kind of fact-based.
Right. I mean, I can see that both at the federal level with the different agencies and their missions and the technologies that are coming out of them, as well as at the university, where you can be going from some new piece for an airplane, for example, to something more like you're referring to here in the life sciences, a new therapeutic for a certain disease. So that kind of background is actually going to be very dependent on the technology. And so, for example, for a university group, it sounds like they would need more than one type of background across those different types of technologies. Just a reminder, we're down to about 3 minutes or so. We can finish up and maybe have any additional questions at the end.
Yeah, I guess I'll just make a couple of key points on this last slide and would like to obviously open it up for questions. We've gone over pre-money valuation, post-money valuation. There's a little example here, so if you want a little cheat sheet, it's on this page. Most important is the pre-money valuation and the pre-money valuation and the post-money valuation are typically, they have to be items of negotiation. But having a fact-based model to back up the points of your negotiation can make the negotiation very easy. On the right-hand side of the slide, or maybe the bottom first, the key element in most industries that they're looking at is risk and profitability. And from a process standpoint, typically the beginning part of this, maybe not as relevant for technology transfers, the very first way that people start describing their valuation is through a term sheet, which isn't binding. It comes after a lot of due diligence typically. And for investors, what they're going to want, so this is why it's important to kind of understand the other side of the fence, they're going to want board fees, reserve matters, there's things called drag-alongs and tag-along rights, liquidation and dividend preferences. They might want to actually have very specific terms around litigation, and potentially a full and weighted ratchet. Ratchets are bad for startups. It dilutes value of future investors. But these are some highly complex items on the right-hand side that startups, if they're coming to you and wanting to license an invention, will have to deal with down the road. So I just wanted to point out that these are just kind of a beginning point.
Yeah. So I think we're coming up to the end here. We do have one more question before we close, and that is most lab tech transfer offices don't have this type of market expertise. So how does a limited staffed federal lab tech transfer office come up with an 80% solution value? And I would like to kind of address this question and then first take a stab at it, and then Rosemary, maybe you could add to that. I can tell you that coming from a federal laboratory myself, that was one of the conundrums I entered into. I am not a business trained individual. I'm a scientist by training, and so looking at our patent portfolio here at the NCI, it became quite daunting to me to try and consider what is the value of some of these technologies that's in this patent portfolio. And I can tell you that what I have experienced is leverage is key. Leverage outside partnerships to get you that experience. My experience with Rosemary, who's actually our speaker here, where we have entered into a partnership intermediary agreement and has helped us take a look at our patent portfolio with that kind of expertise. has been very, very valuable. So, so that's kind of my short answer is reach out and leverage that expertise in and do it in a partnership type of arrangement. Rosemary?
Yeah, I would totally agree, because if you go to a table with a wrong valuation, you're going to start off on the wrong foot with the people who might want to have your license, who might want to have your invention.
Definitely make your discussions more valuable with the outside party, that's for sure. And
yes, so I agree with Tom. You have to find the right people to do the right valuation. You have to make sure they have the industry expertise, the valuation expertise, make sure that they actually know how to do it the right way. And I say the right way, but risk-adjusted NPV is, probably 90% of the time very strong, very, very strong, because all the assumptions you have to build up. It's not something you can take, snap your fingers and create. It does take a couple weeks, actually, but it will not only help you. It will not only help you in terms of the parameters of your licenses or your collaborative efforts that you're trying to establish in some form of agreement. It's also going to help you to prioritize. What's going on in your patent portfolio, which was very valuable to me. So at this point, I'm not seeing any more questions. So Rosemary, if you don't have any further comments, we'll go. No, I just thank everybody for their time, and if you have any further questions, feel free to reach out to me. My website's the Center for Advanced Innovation, and my email is rt@the Center for Advanced Innovation. So I'd be happy to answer any questions, or if you have questions about, for example, what the risk levels for different stages are for your particular inventions that you're dealing with, I'd be happy to share with you my experience. Great. I have my personal experiences across industries, so I can usually address. Thank you very much, Rosemary. We appreciate it. And everyone, I hope to see you in our next live session that begins at 2:30. Thanks. Thank you.